Hi, this is Zak Mir from Master Investor with a look at some Bulletin board hero stocks on Tuesday, the 20th of January. Starting off with Quindell, where we're in the aftermath of this cup and handle formation here. The handle here down to 70 pence. That's a stop loss on the bull argument, and neckline resistance in the first instance back up to £1.20, which leaves some decent upside even from current levels. Stop loss for near-term traders would be the 10-day moving average, currently at 90 pence. Obviously, this stock is still very much trying to recover from a mega downtrend that we had from the early part of last year, but it does look as though at least £1.20 could be on the cards while the 10-day line is held. Next up is Stellar Resources, which was in focus sort of in a positive way earlier last year, but obviously the declines for the autumn were quite painful and very volatile as well. I mean, this is quite a sort of a ride that the traders had over October and November. Current situation, it looks as though we're bumping along the bottom. We've got a support line, an uptrend line from November, also an uptrend line in the RSI window as well, which has been multi-tested, which looks encouraging. But that said, with the 200-day moving average still falling, you might want to wait for at least an end-of-day close back above this September resistance line and the 50-day moving average shown here in blue at 0.44. Before taking the plunge on the upside. The initial target would be the 200-day moving average once the 50-day line and the September line lines are cleared. A stop loss on the bull argument probably back below 0.35 at this stage. Finishing off with Tern, where there's also been a rocky ride as well. Here we had the massive spike for December, quite a sharp retreat there, sort of retracing most of the gains that we had, also with a gap to the downside. That gap around the 7 pence level will provide resistance, and in fact the shares have so far stalled around the 6 pence level. If you're bullish on the shares, you probably wait for at least an end of day close back above this gap around 7 pence. For aggressive traders, going long now with a stop loss back below the 50-day moving average shown here in blue would be the strategy. Otherwise, perhaps wait for a possible retest of this main September support line at 4 pence. But a bit of a mid-range situation there, and as you can see from the RSI at 49, mid RSI as well. If pushed, probably one would still be going for the upside scenario, if only to fill this gap. While the shares are above 5 pence. That's it from me. More updates at Spreadbook Magazine, and don't forget that we've got an event this evening at the Commander in Notting Hill with Gervais Williams and David Lenigas, and if you'd like to sign up for that, visit Spreadbook Magazine.